Income Tax Bill 2025 will come into effect from April 1, 2026, which is designed to simplify the Income Tax Act of 1961, a framework that has stood for over 6 decades. It's a significant change, and today I'll break down what this means for us. There is a complete overhaul of structure, which means that the provisions are now logically organized and easier to follow. There will be no more shuffling through scattered and alphanumeric sections. For instance, all the provisions related to non-profit organizations have been placed together in one chapter. Similarly, in the existing Act, there are 43 sections dealing with tedious provisions, which are now merged into one section. The bill uses simplified presentation by use of shorter sentences, making it much easier to read. It includes over 57 tables that summarize key information like tax rates, tedious rates, exemptions, and compliance requirements. This format will make navigating the law much more efficient for taxpayers. Another significant change is the replacement of assessment year in previous year with the term tax year. This update brings us in line with global tax standards and makes our understanding of tax period clearer. The new bill clarifies that tax proceedings for years up to financial year 2025-2026 would be governed by the existing Act, which implies that even after enactment of the new bill, the existing and new laws would remain in operation together for a few years. The repeals and savings section fairly grandfathers benefits provided in the present law. However, the fate of circulars is still not clear. On taxation of business income, we note the benefit of deduction of intercorporate dividends has now been withdrawn for companies opting for 22% tax rate. Scope of disallowance of income tax is expanded to include tax payable on any income. Similarly, scope of payment-based deductions has been expanded to include surcharge. Going forward, all export incentives would be subjected to tax. Now, Section 197 of the existing Act, which permits issuance of a nil tax withholding certificate for specified receipts, is now sought to be amended to expand the scope to all kinds of receipts, however, for only lower tax and not nil withholding certificates. There are a couple of changes noted in transfer pricing regime, pertinently with respect to meaning of associated enterprise and international transaction, where dust was already settled on some legacy disputes. On M&A and capital gains side, there are amendments affecting tax neutrality of fast-track demergers. Foreign exchange fluctuation benefit is being extended to long-term capital gains in the hands of non-residents. On assessments and appeals, changes are noted with respect to updated returns, processing of tax returns, where we have recently seen a lot of frivolous litigation. Dispute resolution panel is now required to pass a reasoned order, which is a welcome change. However, the provisions which require the panel to consider evidence filed by the taxpayer or a remand report have now been specifically deleted. Some significant changes are also seen on reassessment provisions, and we've also seen a major revamp in the provisions dealing with non-profit organizations, which has made these dreaded provisions way more simpler. What we note is that while the structure has been streamlined, the core tax framework remains unchanged. Some edits in the new bill would certainly have big impact on the industry, and the real challenge will be in the implementation.